Learning objective 3 focuses on notes receivable for you to understand how they're created, how they're recognized, um, what their value is, how they dispose of them. But a note receivable basically is a loan. It's a promissory note, a written promise to pay. Um, and again, in general, how notes receivable are created in business, normally speaking, is when an accounts receivable, which you given the company 30 days, right, to pay, needs to be extended. They need more time to pay. So oftentimes what the receiver will do is say, sure, we'll extend it by 30, 60, 90 days, what have you, but we're going to change it into a loan. And thus it becomes a written promissory note. Okay. So that's important. But I think a lot of times it's simply that these are created to settle any open accounts receivable that companies need longer amounts of time to pay. It does look pretty official. It's a contract, right? You have an amount, right? That's listed here. You have a due date. You actually have a date of the loan. You actually have the company that is making the loan, company that is getting the loan, right, paid back. Interest rates, very important. And remember too, this interest rate is an annual interest rate, although the loan is only for 2 months. This is an annual interest rate. Okay. So this means that Brent company owes Wilma company this money. Okay. So if you're the one who is signing off on the loan, you're the one who owes it. You need a loan, so you owe it. And so they promise to pay Wilma in 2 months. So when the maturity date is the date that it's due. And normally speaking, how this works is the notes are paid back in full on the due date with the interest. Okay, everything is paid all at once on its due date. The due date is the maturity date. So this is a term that you have to know. Okay. Normally speaking, notes are provided either in 2 ways. Most of them are for a number of months. So you'll have a note for 2 months, for 5 months. Some notes can run over 12 months. So some notes can be long-term, but most of them are short-term. Most of them are current. However, there are notes that are listed in days. And that's important to know as well, because when you're looking at months, you're simply looking at months. So if something is, if we made a loan today, April 7th, and it was for 2 months, then you just simply count 2 months, May, June 7th, it's due. But if you looked at it, if you made it in a period of days, you literally have to be counting the days. So 60 days from June 7th, you would need to literally count. It probably would not be June 7th. It might be June 6th, might be, because of the number of days in each month is different. So you would literally need to count the days here to find the maturity date. That's the part I was trying to get to. Okay. Stumbling with words today. Probably the most important part to understand is how we compute interest on notes. We start with the note, the loan itself. We call it the face value, the principal, the base amount. Anyway, it's the amount of the loan. We multiply that by the interest rate. Remember, the interest rate is annual, which means it's for all 12 months. So this is going to give you an annual amount, which of course is going to be too much. So then we have to multiply that by the time. Now that's where the months and the days come in. So normally speaking, if it's a number of months, you put the time becomes the number of months over 12. So if it's 2 months over, if it's 2 months, it's 2/12, because you're breaking up the annual payment into the 2 months that you're owed. You're not owed the full year. You're owed 2 months of it. If it's a number of days, we simplify it. We use the number of days over 360. When we do number of days, by the way, for these notes, we do them in multiples of 30. So it'll be 60, 90, 120, 150. So that's why we use 360 as the base, because we're assuming a 30-day month for 12 months for the year. So that's why we don't use actual days for the computing of this interest on notes. So that's how we would get the interest. So then you have this box showing you how to calculate interest. Again, you have the face value. We're looking at one row at a time. We have a face value of $730, 12%. Remember, that's an annual rate. That's for all 12 months. But this is for 120 days. So now we take the $730, multiply by the 12%, that gives you the annual amount. But now you have to break it into 120 days over 360. So that means that this loan of $730 is going to carry a cost, an interest cost to the borrower of $29.20. On the maturity date, they pay back $759.20, both the interest and the face value. Both of these are paid the same day. So you just add those up to figure out what the value that's due on maturity date. Here is the second note. We have a $1,000 loan at 9%, again, annual rate. But the loan is only for 6 months. So we take the amount times 9%. This is, again, an annual for all 12 months. So we want to break it into just the 6 months of the 12, which is ours, $45 at interest. So at the maturity date, they will be paying $1,045 on the maturity date. That's what they're going to be paying. If you owe it, that's what you're going to be collecting, right, if you're waiting to receive it. And of course, if we do use years, this is already an annual rate. So years are easy. That's why it's 1/1. Or if it's 2 years, it'd be 2 or 3. Just use the number of the year, because it's the interest rate's already annual. It's already for the year, for the full year. So there's no reason to break it up like we had to in the number of days or the number of months. Okay. So let's go through some entries to show how this works on the books. Here we have Brent Company wrote a $1,000 2-month 8% note. Okay. Dated on May the 1st to settle an account. That's the most common thing, right? To settle an account means they're paying their accounts receivable with a note, right? They're turning their accounts receivable into a loan. So their accounts receivable closes and a notes receivable opens in their name. Okay, that's how that works. So prepare the entry for the receipt of this note. So basically the entry would be a new note receivable would be occurring. So you put the note receivable on the books. Again, it's an asset. That's why it's on the debit side. They're using a note receivable to pay their accounts receivable. So the accounts receivable gets closed with a credit for Brent Company. So Brent Company no longer is an accounts receivable. Brent Company is now a note. Okay. So we're waiting to get paid for that note. And again, since it's May 1st and it's 2 months, you can just simply count June, July. So it's going to be due July 1st, period. Very simple to calculate when it comes to months. More complicated when it comes to days, because you're literally going to sit and count the days. Okay. Just like accounts receivable, notes receivable need to be valued properly on the balance sheet as well. We're not going to go through any of the details in this class. You'll get that in an upper level accounting class. But just to understand that these are assets on the books, right? And just because you have a loan that you're waiting to get paid for, it doesn't mean they're always going to be paying up, right? So again, what you saw in accounts receivable and the problems that happen there also happen with the notes receivable. All right. So just, I'll make a note of that, and we're not going to be doing much. So when they use the word dispose, it means simply that, when notes receivable are due, right? So few ways in which notes receivable can get cashed out. They get paid on the maturity date. That's what you're waiting for. That's what you're waiting for. That's what you're hoping for. You want it to be cash, right? On the maturity date, you're expecting the cash. Boom. However, sometimes there's a default, which means that the business that you've made the loan to can't pay. Anytime you see the word default, it simply means they've missed a payment, whether the payment is 1 month's payment or the whole thing. It's a default. It's a lovely term for sure. But when defaults happen on notes, you've got a lot of extra work to do. You need to make an adjustment. You can extend, you can, there's other issues you can do. Now, of course, it's a legal instrument because everything is signed, so it's easy it's got legal teeth in court. So notes are wonderful because they've got all the elements of a contract by law all set. Piece of cake. However, I mean, probably the reason the business defaulted on it is because they're having some major issues. So it's hard to get pennies out of someone who's broke. Right? So that causes an issue where notes need to be redone. And again, notes receivable, just like accounts receivable, are an asset, and you can sell them to a third party. Okay. So you saw that in accounts receivable, they sold it to a factor. Notes receivable can be bundled and sold to investors, sold to others. Why? Because the company needs cash. Okay. So again, you can sell any asset if you need to. When a note is paid on time, we use the word honored to show that it was paid in full on its due date. So the note was honored, contract was fulfilled, no problem. When the note receivable is not paid on time, we call it a dishonored note. So just some terminology around notes receivable. So here we're going to be looking at a note that's got paid, so it was honored. Wolder Company lends Higley $10,000 on June the 1st. That's for a 5-month, 9% note. Okay. So 5 months, you can simply, again, it's June the 1st, you simply start counting months. The maturity date is November the 1st. So what's Wolder going to enter into its records once they get paid for this? Well, the first thing they're going to be getting is a lot of cash. The cash they're going to get is the original loan, the original note, plus the interest on it. So clearly what you see here is the interest is calculated at $375. That's $10,000 loan at 9%. Again, that's annual. We're only collecting 5 months of that, so multiply by 5 over 12. 375 is the interest. So that's how much cash we're getting. But of that 10,375, 10,000 is the note, is the loan itself. The other 375 is money you've earned on the loan. Because you've earned it, it's revenue. So it's going to be credited to the interest revenue account. Okay. Of course, we close the books at a certain period of time. What if you have a note that's outstanding, right? You have a note that's you made in fiscal year X, but it's not due until fiscal year Y. Well, then you have to make an adjusting entry when you close the books. So here on September the 30th, this is incorrect. It should be September 30th. When you close the books, you have earned $300 of that 375. Remember, that note is giving you $375 of interest. However, if you're closing the books in September, you've earned 300 of it in this year, in this fiscal year. You've earned the other $75 in the next fiscal year. So on the 30th, you're going to make an adjusting entry showing that you've earned, this is revenue, remember, You've earned it, but you're going to collect it later. So here we go. The entry on September the 30th would show an interest receivable of $300, but you want to make sure the interest revenue is on the books for this fiscal year. Remember, the whole purpose of those entries, the adjusting entries, is to make sure all the revenue and all the expenses are in the on the record for that year, right? So anything you've earned up until September 30th has to be in the record here, even though you're not going to collect it until the next fiscal year. Okay. So what happens on November the 1st? Well, they're going to get paid the whole thing. So in the case where they've had to make an adjusting entry as of September 30th, they get paid on November 1st, it would look a little bit different. They're still going to collect the full $10,375. And 10,000 of that is the note that's repaid. So their receivable is collected. So they take that off the books. But remember, they had to put an interest receivable on the books because they closed their year September the 30th. So 300 of the interest is going to go to an interest receivable to show that was collected. And the additional $75 is revenue for the new fiscal year that started October 1st because they closed the book September 30th. And we have reached the end of objective 3 with a note receivable. Get out. We were just talking about that. So we have Gambit Stores accepts from Leonard a $3,400 90-day 6% note dated on May the 10th. Now this is interesting, right? This is in days, not in months, right? So if you started counting, you don't count May 10th, you count from May 11th, and you count 90 days, this thing matures August 8th. Because literally you are counting specifically 90 days on the calendar. You don't start on May 10th, you start on the 11th for 1 day, right? So that's how it differs for days when it comes to when the note is going to be due, when the maturity of that note is. It's easy for months. Days, you got to sit, count the days on the calendar there. Okay, so what entry does Gambit make on the maturity date on August 8th? Well, on August 8th, what's going to happen? They're going to get their $3,400 back plus 6% interest on that $3,400 for 90 days. So you do a little calculation, and you're going to see that they're going to earn $51 of interest on this note, and so you're going to collect $3,451 of cash to show a collection of the $3,400 note, and the $51 that you've earned becomes interest revenue. And we're done with the notes. Learning objective 4 looks at receivables first on the balance sheet here. So here is a partial balance sheet for Deere and Company. I hope you know that Deere and Company is quite a large industrial company in the United States. You've probably seen the green tractors, whether it's on a farm or people mowing their lawns or doing other things. They make a lot of equipment. So, so they're very, very popular. And I just love their name because you can make lots of puns with this. So you see here, they have lots of receivables. So total receivables are listed here at 37 billion, because these are in millions, so you're gonna add 6 zeros. As you see here, they have their allowance for doubtful accounts listed here as allowance for doubtful trade receivables. See, same name, same type of name. So they take away a little bit of dough from that, but that still leaves them with quite a few bucks to collect in receivables there. 36 bill, a lot of bucks for sure, for sure. But again, don't forget they have to take away a little bit of dough for that allowance. Oh dear. Managing receivables is a tough job because you've basically extended credit to people who are buying from you. Again, mostly these are businesses, and so you've got to make sure you are giving credit to the right businesses that they can actually handle that and pay you on time. You have to establish a payment period, make sure you're collecting things on time. Are you, again, most receivables are due in 30 days. So are you being paid every 30 days or less? So evaluating the liquidity of the receivables is important. And sometimes you have to sell those receivables or offer discounts to collect the cash more quickly. So managing receivables is a big deal, you can say. Okay. So again, this little note here is good, talking about how bad information leads to bad loans. Again, in order to extend credit to anybody, you're relying on information. So if your information is not very good, I wouldn't be expecting the loan to get paid back. So again, your book talks a little bit about that. Okay. But the important thing here in Learning Objective 4, outside of how receivables are listed on the balance sheet, is how to do some analysis. And these are really important analyses. The one that we always start with is what we call the accounts receivable turnover. Now, again, a turnover is about how quickly we are collecting them every year. So again, if you think about it, receivables are due every 30 days. And every year there would be 12 30-day periods in it, because roughly 30 days is about a month, and there's 12 months of the year. So you should be turning over your receivables 12 times a year if you have a 30-day receivable window, which most businesses do. There's some industries that work on 45 or 60 days, but most businesses are 30 days. So you should be turning those over 12 times a year. 12 times a year. Every 30 days is roughly 12 times a year. So we start with the receivable turnover and measure it against the standard. Once we know what the turnover rate is, we can put that number underneath 365 and actually calculate the actual number of days that it's taking a business to collect. Okay. So again, mostly we are always starting with the turnover rate. That's the first thing. After we get the turnover rate, we can convert to a number of days. So let's see how it works here. So to do an accounts receivable turnover, you are going to use this formula here. We have the net credit sales. Remember, credit sales are sales on account. And we divide that over an average receivables. So an average receivables is your beginning and ending receivable divided by 2. Once we get that number, that turnover rate, as you see, that turnover rate simply gets put below 360 and we calculate. So let's take a look at Nike for their accounts receivable turnover in the year 2014. Based on their numbers, they had $27,799 million in credit sales. A lot. You divide that over the average receivables, so this is going to be averaging around 3.2, 3.3, somewhere in between there. That means that Nike is collecting 8.5 times a year. Well, that's well below 12. So Nike is just not keeping up with their collections very, very well. Now that we know that it's 8.5 times a year, we can put that 8.5 under 365, and it'll tell you that Nike collects their receivables every 42.9 days, so roughly every 43 days. Well, you want to get paid every 30 days. Here, you're waiting 43 days, roughly. So that's not great. That's not terrific. However, it's better than their 2013 numbers. Same company, different year. Their 2013 numbers were lower. So the fact they've increased it is a good sign. They're on the right track. Get it, Nike's on the right track here. So they've increased that, but it's not good enough. Skechers here has slightly better numbers, right? Their turnover rate, 9.6 times a year, better than Nike, but still not at 12 or higher. So they're below. They're collecting their receivables every 38 days. Again, that's not great. I mean, if you want to get paid every 30 days and you're waiting every 38 days, it's not a great thing, right? So again, receivables are going to turn into cash. That's why it's so important to keep track of this. The industry, that's all of these types of companies. And I know you're looking at Skechers and Nike and thinking maybe sneakers and stuff like that. They actually want to consider themselves to be, sportswear type of thing. They are looking at them as athletic wear, athletic gear type companies. They don't want to be known just as making, great sneakers for things. They want to be known as the full. If you're going to go work out, you're not just going to wear Nike sneakers. You're going to wear the whole outfit. That's what they want. Okay. So the industry is doing quite well. Their accounts turnover is 12.2 times. So that checks a box in our mental. They're doing in our mental head list there. 12 times is what we're looking for. The industry is at it. Putting 12.2 under 365, right? That's that formula. Gets 29.9 days, so every 30 days. So they're doing good. They're doing really, really good. Compared to, Skechers compared to the industry is looking a little bit sketchy, if you ask me. And Nike is running behind on all of this here. So I will tell you, if I were the vice president of finance or one of them at Nike, and I saw these numbers, I would be calling a big meeting with all the folks there and showing them these numbers, where we're at right now and where we want to be, at least what the industry is doing. And I would look at them and just say, just do it. Okay. Sorry about that. You knew the puns were coming eventually. So again, knowing the accounts receivable turnover and the collection period, very, very important. So here we have an example at the end of Objective 4. LeBron James, they had credit sales of 923,795. Right, there's your credit sales here. You have beginning accounts receivable of 38,275, ending receivables of 35,988. So you're going to average those out. So what is the accounts receivable for LeBron James company? Well, their receivable turnover ratio, when you take the credit sales of 923,795, divide that by your average receivables, that's 24.9 times a year. That is way above 12, as you know. So, this company is collecting things faster than anything. Right? When you take that 24.9 and you put it under 365, you'll see their collection period is 14.7 days. So basically every 2 weeks, these folks are getting paid here, which is excellent, right? I mean, you want to collect cash as quickly as possible. All right, so that is, in a nutshell, Chapter 8. Questions?